With us to break it all down, angel investor, tech entrepreneur Jason Calacanis is with us. Jason, welcome back. Good to see you again.
It's good to be home. How are you, Carl?
I'm good. I've been wondering what Jason thinks about Lyft having worked its way down from the mid-80s in just a few days. What are your thoughts?
Yeah, I mean, everybody gets a little obsessed about IPO pricing, and it's super exciting. But what we see here in Silicon Valley is these stocks are now trading in the private market for a couple of years before they go public. So it's really not that big of a deal for us. I get offers every day for my shares in Calm or Robinhood or Uber or Thumbtack. There's a whole secondary market going on here. As long as we price them within, I think, 10 to 15%,
I'm glad you're good.
It's going to be fine.
I'm wondering what you tell people who bought at 80.
Yeah, if you're buying stocks to flip them and you get burned, you're a gambler. So you get what you deserve. And if you double your money or you make 20% in a day or a week, congratulations. But let's be clear, you're gambling. I think you should be looking at these stocks and trying to hold them for 5 or 10 years, because we always overestimate what these companies can do in the short term, and we underestimate what they accomplish in a decade. So buy it and hold it for a decade, and don't worry about 10 or 15% in the first couple of weeks or days. It's meaningless. Take a longer outlook.
Which, Jason, begs the question. I mean, there's a lot of focus on whether Lyft shares have been falling recently because there's this expectation about Uber going public next month, whether there's a so-called pair trade that could be playing out here for investors. What should folks who maybe want to buy these and hold them for the long term do? Do you invest in both? Do you focus on one? I mean, we talk about them both because they're ride sharing, but they are essentially two very different companies.
Well, I made my bet over 10 years ago when I was the third or fourth investor in Uber when it was a $5 million company. So I have a horse in this race. I always like to bet, the leader. I think, we have a Google, Yahoo, Facebook, Twitter sort of situation here. One of them is going to be the leader of the duopoly, and one of them is going to be the follower. And, I always like, and I believe that the person who's in the lead is going to have more data, more pricing power, and more network effects. So the fact that you can get off an airplane anywhere in the world almost today and take out your phone and get a cab at a great price with a great service, just like Starbucks went across the globe, Uber's gone across the globe. And I think that's the big win there. Obviously, I'm biased. Obviously, I have a horse in the race.
Yeah, a fast horse at this point. And I wonder, how long do you keep that horse once it wins the race for you? I mean, a lot of speculation around who exactly was selling Lyft, probably some people who had been holding the stock for a long time. You've been holding Uber for a long time. How obligated do you feel to keep holding all of those shares that you've had all this time?
Well, I always take Jim Cramer's advice. You want to be diversified. Am I diversified? I gave Masa a little bit of my Uber shares during the Masa IPO. I'm not suggesting that Masa IPO is what we should be doing here in America. Actually, I think we should be boycotting the Saudi money until they solve their human rights issues, candidly. But I did give Masa a little bit of my shares, so I'm doing okay, and I think I'm going to hold for the long term the rest, because what I've learned from my friends at Sequoia Capital and Bill Gurley at Benchmark is a lot of times the growth that we see after the IPO, specifically Google, Amazon, Netflix, Apple, you want to hold those companies. And I believe the Uber story is just getting started. It's just getting started.
All right, we're going to watch it obviously closely. Viewers hopefully take your advice, maybe take a longer-term view. We're going to turn to Disney, unveiling its challenge to Netflix today, an ad-free monthly subscription service called Disney Plus, expected to launch later this year. Chairman and CEO Bob Iger also making headlines with some harsh criticisms of social media, saying, quote, Hitler would have loved social media. It's the most powerful marketing tool an extremist could ever hope for. To help us dig through all of this today and the next several months as we watch Disney Plus, Julia Borsten's here at Post 9. Los Angeles Times says November. Do we believe that?
I think it makes sense. Look, I think that Iger's going to want to get the service out before the key holiday season, going to make it the kind of thing where maybe you get a free trial period and then really trying to get people to subscribe and start paying around Christmas. But I think this is the kind of thing where people go to the theme parks a lot around the holiday season. This would be a good way to maybe introduce it in a free trial for everyone who visits the theme park.
Any sense on what pricing could be?
Well, so Iger has said it's going to cost less than Netflix. Now, the most popular Netflix service is about $13. The cheapest Netflix service is $9. So I think it'll be in the $6 to $9 range, $6 to $8 range. I'd say less than the bottom of Netflix.
Jason, is Disney doing this right, you think? I mean, I know we talked months and months ago about your grand vision for how this could all play out, kind of like a membership, you know, wrap in the parks, not just the movies. Where do you think this should head?
Service to hit 250 million subscribers, double what they have today. But I think Disney will be the first to hit 500 million subscribers. And I think there's no doubt that Disney will become the leading candidate a decade from now. It's going to be a horse race. But what this is going to do for Disney, and Bob Iger is amazing for being so candid about social media, and he's right. But what's really amazing, I think, is what Bob Iger has done in managing this transition. It's a classic innovator's dilemma. They have distributors paying them a ton of money for the Marvel movies, for the Star Wars movies, and now they have to lose that revenue in the short term. But what they'll gain is not just the revenue of the Disney Plus service. They're going to get all that data, and then they're going to have hundreds of millions of credit cards online. And Netflix does not have a theme park. Netflix does not have an advertising business. Netflix does not have a merchandising business. What's going to happen over the next decade is you're going to see Disney buy every piece of intellectual property at a price that Netflix could never pay. Apple is going to be a complete disaster. They'll fail that service, and they'll probably deprecate it in the coming years. That's going to be a disaster. They'll be a non-player. But Disney will exceed Netflix's subscribers in the next 10 years. Guaranteed.
Julia, is that really, or maybe Jason's talking about ESPN and Disney Plus, because Disney's got a lot of irons in the fire.
It does. Look, Disney owns a majority of Hulu. It could buy even more of Hulu. It also owns ESPN Plus, which has been pretty strong out of the gate. And also, I'd like to point out that Hulu Plus, its streaming service, has been growing faster than Netflix in the U.S. this year. So that's pretty remarkable. How big Disney gets really depends not just on how much it costs, but also on how much content they put on there. And Iger has been very clear that they're going to charge for an amount that's fair for the amount of content. But to go back to what Jason was talking about with Iger's comments about social media, in a lot of ways here, Iger is really positioning Disney Plus as the anti-YouTube, as well as the anti-Facebook. And as Facebook moves more into content.
Like Apple, Facebook, Disney, YouTube, in other words.
Yeah, and also Facebook to a certain extent, because remember, Facebook is investing more in content. But whereas Facebook is about this open platform, and it's about user-generated content and sharing of content, Disney Plus is all about premium, safe content. You know exactly what the brands mean. You know what you're getting, and there's no ads. So really, two different worlds here, and it's going to be really interesting to see. You know, Jason mentioned that Disney will have all this data for ad targeting, but I think here what Iger wants is to be really clean. This is not about ad targeting. This is about subscription and then premium content.
It's an incredible evolution, Jason. I mean, I remember when the knock on Disney was that they were not tech savvy. Do you remember that? It seems like it wasn't all that long ago. And all of a sudden now you got magic bands of the parks, and they're about to leverage this huge streaming opportunity.
Yeah, I mean, the big players move slowly, but when they take a step, it can have a big, thunderous impact on an industry. And I think that's what you'll see here. It was very scary for them to obviously lose these existing revenue streams, but the data they're going to see inside of those apps and the ability to have 100 million credit cards on file is really powerful. We've seen this with Amazon Prime. We've seen it with Apple Pay and Apple iCloud and the App Store. And so this is going to just put massive wind in Disney sales, and they're going to get closer to the customer. And really, the companies that excel in this new century are the ones who are closest to the customers, and the closest way to get to your customers is to be on their phone and to have their credit card and to have data about them. And this solves all those problems for Disney.
Jason, I think owning that direct-to-consumer relationship is going to be very valuable for Disney, and I think the real thing to watch here is whether Disney can use this streaming service to continue to drive people to go buy tickets to its movies, continue to drive people to its theme parks, and not potentially cannibalize the movie business. They're going to have this big, very expensive, pricey Star Wars spin-off TV show called The Mandalorian. So they have to use that to make sure people are going to go and buy tickets to the next Star Wars movie in December and not say, oh, hey, I got this great Star Wars experience in my streaming service, not necessarily worth buying a ticket.
All right, quickly, Jason, before we move on to our next topic, bottom line, in light of this entire conversation, should Disney be trading at a higher multiple?
Yeah, I'm not a day-to-day trader. I will say, if I had only 5 stocks that I ever could buy in my life, Disney would be one of them. I would buy it and hold it for a lifetime. Your kids, my kids, our kids' kids, they're all going to be watching, this incredible Marvel industrial complex they built over the last decade. They're all going to watch the Star Wars films, and the velocity in which they're creating this content has gone up. We got 3 Star Wars films over 20 years when we were kids. Now there's 2 or 3 Star Wars films a year. We would get 1 superhero film every 5 years. Now we get a dozen a year, and 6 of them are from Marvel and Disney. So I think this is the company that wins it all in terms of entertainment, candidly.
Yeah.
And I think Netflix is in trouble. I think this is going to be very, very hard. If your kids come to you and say, can I have Pixar, Marvel, and Star Wars, or Orange is the New Black, or whatever's on Netflix, it's going to be a very easy choice.
Not a fair comparison, but okay, we get your point, Jason. Julie, thanks.
Yeah.
It's going to be a fascinating day out west. Finally, let's talk a little Amazon. The company confirms a report this morning that a team of its employees listen in on Alexa recordings taken from users' Echo speakers, transcribing and annotating those conversations in an effort to improve the software. In a statement to CNBC, Amazon said, quote, we only annotated an extremely small number of interactions from a random set of customers in order to improve the customer experience. Of course, we got the shareholder letter out today as well, Jason, where Bezos talks about Echo being always on. Is this a liability or an opportunity?
I own 6 of these devices, and none of them are plugged in. I can assure you that these systems are hackable, and I can assure you that employees are abusing their access to them. The reason I can assure you of this is because we need only look at the history of Facebook, the IRS, and Google, where employees have been caught over and over and over again looking at their ex-spouses or boyfriends or girlfriends or celebrities, DMs, instant messages, tax returns, whatever it is. If there's a system that can be abused, it will be abused.
Why do you have
it was a
them
mistake. It was a mistake. I bought them. I played with them. I'm a technologist. I need to be up on them, but I don't think you should have these in your houses. And I would say I'm 70% sure that the Alexa devices have already been hacked by Putin, the NSA, Julian Assange, or China. Well, maybe not Julian Assange anymore because they picked him up today, but, thankfully, because he's a hacker. He's not a journalist.
And
I think these Alexa devices are too dangerous.
Of course, there are human beings listening to the recordings on Echo devices. That's how you train AI. There has to be a human involved validating what the AI thinks it's hearing. So I think fundamentally, and part of what we try to do here on CNBC, certainly on Squawk Alley, is bring people a sense of how this technology works. That's fundamental right now to how this is working. It's humans plus machines, and the only way you can be sure that the machines are getting better is by testing them against humans. Jason, do people get this? Should there be some warning label that comes with these devices, even perhaps letting people know, here's how the technology actually works?
I would say the defaults matter, and that if I was Jeff Bezos right now, I would default all Alexas to have this feature off, the training data feature off, and then I would allow people to opt into it and give them something in exchange for opting in for training it. We're all being opted into a great security and privacy experiment, but we didn't actually sign up for it explicitly. It's buried somewhere in the terms of service. So, you'd have to be pretty naive to think that this couldn't be hacked or it hasn't been hacked. And, the more important you are and the more important the information you have, whether you're a celebrity or a politician or a CEO or an investor, the more of a target you are. And it sounds crazy to think that, investors or CEOs might be targeted or celebrities. But look, everybody's iPhones got hacked in the frappening, and, corporate espionage is just at an all-time high. And the Chinese and the Russians, they have real reasons to get into this data and have compromise on our politicians or CEOs to then get more information. I know I sound like a Luddite, but the idea of having everything you say always recorded is probably the mistake that we're going to make as a society. We're basically building our own police state. I would not buy these devices, and I would unplug them if you have them until such time, as you decide that your privacy is not important and what you're saying is not really that important and you're fine with it being exposed. Or they take an Apple-like approach where nothing is stored and it's all processed on your local device. Apple's long-term privacy plan is the winner. It's just that the other data companies haven't been called out on their BS yet and their nonsense. The Googles and Facebooks and Amazons are being called out now, and they should be.
Yeah. That was a good one. A good few minutes with you. Didn't get a yum-yum, but I assume that would have been for Disney.
Yum on Disney. Yum on Disney. And yum for JCal on Uber.
Jason,
thanks. Every time.
Jason Calacanis.